Have you ever felt like you've been working tirelessly for years but still can't save enough money? Despite having a fairly stable income, life seems to revolve endlessly around bills, debts, and worries about your financial future. The reality is, many middle-aged people find themselves in the same situation. It's not because they don't earn enough, but because they unknowingly fall into financial traps that seem harmless, yet quietly drain their wallets and block their path to building true wealth. In today's video, I'm going to share with you the top 5 financial traps most common in 2025. These are mistakes many people face regardless of their background, income, or social status, and they could be the very reasons you haven't yet achieved the financial freedom you desire. More importantly, I'll help you identify these traps early and show you how to avoid them smartly and realistically, so you not only save money, but also learn to protect it, invest wisely, and build lasting wealth in the years ahead. Trap 1. Buying on 0% interest installment plans, the silent cost of convenience. In recent years, 0% interest or no down payment installment plans have become increasingly popular. From expensive electronics to cars and home furniture, everywhere you look, there are ads promising no interest for 12 months, installments starting at just a few dozen a month, and no upfront payment needed. These seemingly harmless offers are actually one of the most dangerous financial traps that many middle-aged individuals unknowingly fall into. After age 35, everyone wants to upgrade their quality of life, take better care of their family, have a safer car, a more comfortable sofa set, or simply a bigger TV to enjoy family nights. Installment plans seem to solve these needs without immediate financial pressure. However, because payment isn't required right away, many people easily slip into overspending. When a purchase is broken down into affordable monthly payments, it becomes easier to decide to buy. Gradually, you're not just financing one item, but several: new car, sofa, multiple appliances, and the total monthly payments can reach 30 to 40% of your income. This severely impacts your ability to save, invest, and manage cash flow. Even a single late payment can trigger hefty penalties and high interest. Some contracts include retroactive interest clauses, meaning if you miss a deadline, they recalculate interest from day one, turning what seemed like a cheap purchase into a costly burden. What's worse, the consequences of these installments are not just losing extra money, but missing the chance to build wealth. At middle age, you don't have the luxury of time to recover from financial mistakes. Instead of investing in retirement funds, buying long-term stocks, or saving for major goals, you are consistently paying off items that lose value the moment they leave the store. Financial freedom, the very goal you should be approaching, drifts further away. Remember, the danger isn't in big, obvious expenses, but in the small, accumulating costs that quietly erode your personal finances over time. The solution isn't to completely avoid all installment plans, but to be clear-headed and proactive. Before committing to any 0% financing, ask yourself, would I be willing to pay the full amount up front? Is this purchase truly necessary? Will buying it affect my savings, investments, or retirement plans? If the answer isn't clear, the smart choice is to delay or skip it altogether. Face reality. Keeping money is more important than spending it. A wise decision today can make a huge difference for your future. Steering clear of financial traps hidden behind the 0% interest veneer not only helps you control cash flow better, but also opens the door to lasting financial freedom and peace of mind in the years ahead. Trap 2. Owning too many credit cards. In modern society, credit cards have become an essential payment tool, almost inseparable from every consumer's wallet. Especially in the U.S., owning multiple credit cards has become a financial norm that many believe offers flexibility and maximizes personal benefits. Tempting offers like points for rewards, up to 5% cash back, or exclusive discounts for cardholders make credit cards hard to resist. But behind this convenience lies one of the most dangerous financial traps: owning too many credit cards without proper control. There's no denying that credit cards bring many conveniences in daily life. You can pay quickly without cash, enjoy purchase protection for online shopping, and receive special offers from service providers. However, this convenience often leads to overspending. When you use a card instead of cash, the feeling of losing money becomes blurred. This easily triggers unnecessary purchases because it feels like you're not really spending money. The problem worsens when you hold multiple credit cards simultaneously. Each card has different credit limits, billing cycles, and perks. This creates the illusion of having more money than you actually do, making it easy to spiral into debt. Missing just one payment deadline can result in exorbitant interest rates, typically between 18% and 25% annually, plus penalties. Worse, prolonged late payments can severely damage your credit score. A low credit score not only makes borrowing difficult in the future, but also increases interest rates when you need to finance a home, a car, or refinance existing loans. For those in middle age, this phase demands financial stability and retirement preparation as top priorities. Carrying prolonged credit card debt causes psychological stress and directly impacts your ability to save, invest, and plan for retirement. Instead of letting your money work for you through long-term investments, you end up paying interest to banks for short-term spending long gone. High credit card debt reduces net worth accumulation, a critical factor in building financial freedom. A common mistake many make is believing that the more credit cards, the better. In reality, owning too many cards without a clear strategy only leads to loss of control. Each month, you must track numerous credit limits, due dates, and reward policies. This not only causes confusion, but also mental burden. Moreover, opening multiple credit accounts in a short period can flag your credit profile as high risk, complicating other financial transactions. The solution isn't to abandon credit cards altogether, but to learn how to use them wisely. Start by limiting the number of cards you own. Usually one or two are enough to cover essential spending and take advantage of reasonable rewards. Choose cards with clear policies that fit your spending habits, like cashback cards for gas, groceries, or travel if you travel frequently. Most importantly, always pay on time and, if possible, pay your full balance each month to avoid interest charges. Additionally, regularly monitor your credit reports to ensure no unusual transactions or errors in debt records. Maintaining a high credit score not only helps you borrow at lower rates, but also serves as a measure of your financial health. A good credit score can open doors to opportunities like mortgage refinancing, real estate investment loans, or quick approvals for other favorable financial services. Finally, remember, credit cards are a tool, not a free money source. Used properly, they help build strong credit history, leverage smart rewards, and manage cash flow effectively. But without control, they quickly become a burdensome financial trap. At middle age, when you're at a pivotal stage in life, choosing between short-term convenience and long-term financial security will determine the success of your journey toward freedom and peace of mind.
Trap 3. Saving cash without investing. On the journey toward financial security, especially after the age of 35, many people instinctively choose a familiar solution, putting their money into a traditional savings account. They regard it as a safe investment, a place where their money is preserved and shielded from the unpredictable swings of the stock market or riskier investment channels. Watching the numbers in their account steadily climb month after month, year after year, brings a comforting sense of security. It's a measurable safety, simple, requiring no deep financial knowledge, and free from the psychological pressure that market volatility can cause. Yet behind this safety lies a harsh financial reality that many fail to recognize early enough: inflation. Inflation silently erodes the purchasing power of money little by little, year after year. You may see your savings balance rise, but that doesn't mean its real value is increasing. In fact, if your savings interest rate is lower than the inflation rate, which has been very common in recent years, you are quietly losing money without realizing it. Imagine you deposit $50,000 in a savings account earning 1% interest annually, while the average inflation rate is 3%. After 10 years, your nominal balance might exceed $55,000. But in reality, its purchasing power could be equivalent to only about $41,000 in today's dollars. In other words, you have lost $9,000 in value simply by trusting what you believed was a safe option. The preference for saving often stems from a fear of loss, an understandable and widespread emotion among those entering or already in middle age. After years of hard work, everyone wants to protect their achievements and avoid gambling with financial markets they see as opaque and volatile. But the truth is, avoiding all risk also means rejecting opportunities for asset growth. When you only save and don't invest, your money is left dormant, and time, instead of being your ally, becomes your enemy. Especially in today's economic context, where inflation remains a persistent concern, keeping all your idle funds in a savings account can be a dangerously short-sighted strategy. The safety you feel today could become the very barrier that prevents you from achieving financial freedom tomorrow. Numerous studies show that to ensure a comfortable retirement, middle-aged individuals need asset growth that outpaces average inflation by at least 2 to 3% annually. This goal is nearly impossible to reach relying solely on traditional savings accounts. So what's the solution? No one expects you to become a financial expert or to risk all your assets in the stock market. But the important thing is to start learning and investing wisely, even with small steps. Safer options like index funds, exchange-traded funds, ETFs, or retirement accounts such as IRAs or 401ks can be ideal starting points for beginners. Index funds are passive investments that track the performance of a broad basket of stocks, such as the S&P 500. Over the past 30 years, the S&P 500 has delivered an average annual return of approximately 8 to 10%, far exceeding inflation. ETFs operate similarly but are more flexible and can be traded like stocks. For those preparing for retirement, accounts like Roth IRAs or 401ks not only help you invest effectively, but also offer tax advantages, an enormous long-term benefit. Most importantly, you don't need a large sum to begin. With just $50 or $100 a month, you can build a consistent investment habit, what financial experts call the power of time in investing. Starting early and staying persistent allows you to harness compound interest, one of the most powerful tools for growing wealth over time. Escaping the traditional savings trap does not mean abandoning safety. It means redefining what financial security truly means in a practical sense. Safety is no longer just keeping money in the bank. It's ensuring that your assets are growing faster than the currency's loss in value. In middle age, time is your most precious asset. Every year that passes is a missed opportunity for your money to grow. By proactively shifting your mindset, educating yourself about basic investment channels, and making wise financial decisions, you are laying the foundation for a freer future, where you not only have money, but also the freedom to choose the life you want to live.
Trap 4. Buying a home beyond your financial means. For decades, owning a home has been an inseparable part of the American dream, a symbol of stability, success, and a solid foundation for building a lasting life. For many, especially those over 35, home ownership represents more than just material value. It is a deeply personal and social achievement. A house is not only a place to live, but also considered a long-term investment, a way to build wealth through the appreciation of real estate over time. However, behind the glamorous facade of the dream of homeownership lies a harsh reality that often goes unspoken, a financial trap many middle-aged individuals fall into, purchasing a home beyond their means. The pursuit of a larger, more beautiful house in a dream neighborhood often comes at a steep price. Decades-long mortgage debt, mounting maintenance costs, rising property taxes, and escalating homeowners' insurance premiums. Many people, after signing the contract on their new home, realize that most of their monthly income is being swallowed by housing expenses. They no longer have enough left over to save, invest, or even cover basic living costs. This situation is known as being house poor, appearing to own a valuable asset but in reality lacking the cash flow to support daily life. The root cause lies in buying a house before being truly financially ready. Many get caught in the now or never mindset, fearing that home prices will keep rising and they will miss out on the opportunity. They believe that if the bank approves the loan, then they can afford the house. But borrowing capacity does not equal sustainable affordability. A large mortgage can become a crushing burden on personal finances for years to come, especially amid economic fluctuations or unstable income. Moreover, many overlook the additional costs tied to home ownership. Beyond the principal and interest payments, homeowners must cover insurance, property taxes, regular maintenance, unexpected repairs, and sometimes community fees if living in managed neighborhoods. These expenses can add up to thousands of dollars annually, and if not anticipated, can easily derail your budget. A key financial guideline recommended by experts is to buy a home only when you have at least 20% down payment, and ensure that your total monthly housing costs, including mortgage, taxes, insurance, and maintenance, do not exceed 30% of your after-tax income. This ratio offers a safety buffer, allowing you to enjoy your home while maintaining financial flexibility for investing, saving, and meeting other essential needs. Furthermore, instead of choosing the biggest house you can afford, consider a home that fits your lifestyle and long-term financial goals. A smaller house in a convenient location with low operating costs and aligned with your actual needs can bring far greater peace of mind and financial stability than a sprawling mansion that fills you with dread every time the bills come due. In today's environment of fluctuating mortgage rates and rising living costs, controlling housing expenses is more crucial than ever, especially for middle-aged individuals preparing to stabilize their careers and plan for retirement. Wise financial decisions made today will help you avoid persistent financial strain in the future. A home should never be a financial shackle, but a source of security and freedom. Don't let the dream of homeownership turn into a nightmare of debt. Calculate carefully, prepare thoroughly, and only commit when you are truly financially capable. That way, you will gain not just a roof over your head, but peace of mind and solid financial footing.
Trap 5. Lack of a clear retirement plan. After years of hard work, everyone hopes for a peaceful retirement, free from financial worries, unshackled from work obligations, able to enjoy life with family and friends, or pursue forgotten passions. Yet, one of the most critical financial mistakes many people over 35 make is not having a clear retirement plan. The reality is that many postpone retirement planning because they believe they still have time. They prioritize immediate needs, paying off debts, raising children, daily expenses, or even just enjoying the present moment. Investing in the future often gets pushed to the bottom of the list. Others feel overwhelmed by financial jargon or assume they need a fortune to get started. So they choose to avoid thinking about it altogether, and that is a dangerous financial trap. The seemingly simple benefit of avoiding retirement planning is the relief from current financial pressure. Not having to set aside money each month for retirement means more budget available for today's needs. But this is only a temporary gain. Over the long run, failing to prepare will force you to work beyond the age you should be resting, become dependent on your children or government assistance programs that are insufficient to maintain a stable standard of living. Worse still, you may miss out on building wealth through the power of compound interest, a crucial factor in creating lasting financial security for old age. Remember, retirement is not an unexpected event you suddenly reach. It is a goal that requires early preparation. And preparing for retirement doesn't necessarily mean starting with a large sum. Even setting aside a small monthly amount in accounts like a 401k, Roth IRA, or traditional IRA can make a significant difference over time. The earlier you start, the more time your money has to grow. With compound interest, every dollar invested today will generate many more dollars in the future. Moreover, having a clear retirement plan grants freedom of choice. You won't be forced to keep working when you should be resting. You can choose to retire early, travel, pick up a new hobby, or simply enjoy life without worrying every time food prices, medicine costs, or healthcare expenses rise. A solid retirement plan is the key to living proactively instead of scrambling reactively to life's uncertainties. For middle-aged individuals, those who have already passed the midpoint of their careers, starting today is essential. Even if you've never contributed to a retirement fund before or feel you're starting too late, it's never too late. Many companies in the U.S. offer 401k plans with employer matching contributions. If you don't take advantage of this, you are literally leaving free money on the table, a mistake you can't afford. Additionally, Roth IRAs and traditional IRAs come with tax advantages that help optimize your cash flow in retirement. The key is understanding these tools, setting clear goals, and having a disciplined contribution strategy that fits your personal budget. You don't need to be a financial expert to start. Today, many user-friendly investment platforms make it easy to open accounts and automate monthly contributions. One important point to note is that average life expectancy in the U.S. is increasing. This means you may live 20 to 30 years after retirement, and that entire period requires funding through a solid financial plan. Relying solely on Social Security benefits will not be enough. Recent studies show many Americans enter their 60s without sufficient funds to maintain a minimum standard of living, largely because they failed to plan early. Finally, view retirement planning not only as a responsibility to yourself, but also as a commitment to your family. When you achieve financial independence in old age, your children are spared the burden of caregiving costs, and you can live with dignity and freedom. In summary, don't let retirement become a stage filled with anxiety. Start building your plan today, no matter your age. With consistency, discipline, and perseverance, you will create a solid foundation for a peaceful, independent, and joyful future. Thank you for staying with us until the end of the video. We hope today's insights helped you recognize common financial traps and how to avoid them to live more freely and proactively. If you have your own stories or questions, please leave a comment. We're always listening and ready to support you. Don't forget to like, share this video with loved ones, and hit subscribe so you never miss valuable content ahead. See you soon in more inspiring and meaningful videos.